Welcome to Pique Your Interest, your go-to podcast for all things mortgage and real estate. Hosted by Tanner Greenwald and Tim Malaskis. We bring you expert insights to help you buy, sell, and invest with confidence. Let's dive in.
Welcome back to the Pique Your Interest podcast, the podcast where we seek to demystify all things mortgage and real estate related. I am one of your hosts. I'm Tim Malaskis, a loan officer here at the Millersville branch.
I am Tanner Greenwald. I'm also here at the Millersville branch.
And we are going to talk to you today about the components of a monthly payment. I guess maybe it's mostly first-time home buyers that ask us these kinds of questions, but I think it's a good refresher for everybody.
Yeah.
Even if you've had a mortgage before, it's still pretty good idea to kind of get, bone up on what some of these things are. So, the first part that everyone thinks about is the principal and the interest part of the payment, because that's what makes up, for the most part, the biggest parts of your payment. And so if you break those two into their individual portions, you've got principal. Principal is the amount that you borrow. Your original principal balance is the amount of a mortgage or a loan that you take out, and over time, that principal decreases as you make your regular monthly payments, obviously with the goal of it becoming zero at some point. And then the second part of that is the interest. That's the part that's really scary for a lot of people. That's what the nature of it. But the interest is, the interest that you're paying to whoever the lender is or whoever the servicer is. Obviously over the last few years, we've seen rates go a little bit higher. And so the interest portion of that payment is a lot higher. And over time, the amount that goes toward interest decreases.
Yeah.
And conversely, the amount that goes toward your principal increases. So over time, you start paying less interest, more principal, which is, kind of what the goal is just get that principal as low as you can. And another component that makes up a big part of the mortgage payment is the property taxes. Whatever you pay to your local municipality for owning that property, 1/12 of whatever the yearly amount is included in your mortgage payment. Now, there are times when you can not include it in your mortgage payment, but you're still paying it regardless. And, for probably most of my career, I think probably 95 to 99% of people escrow it. And so it is a part of their mortgage payment.
Yeah.
What else makes up a mortgage payment?
Yeah. So we have homeowner's insurance, which is typically required by lenders if you're looking to purchase a home. It's something you can shop for as well. So there's no really set, here's what your homeowner's insurance is going to be a month kind of thing. So all it is it's insuring the home that you're buying. So if there's any type of weather damage, if there's theft going on, it's there to have insurance to, fix anything up that deals with that. It's also included in your escrow accounts. Mortgage insurance. So mortgage insurance, it kind of depends on which loan type you're going through to explain what it is. So mortgage insurance protects the lender. If you're going FHA as a loan type, you have mortgage insurance as a part of your monthly payment for the life of the loan. It's at a set percentage rate set by the government, and we can't change it. It just is what it is. If you're going conventionally, mortgage insurance is required as well. But once you reach a certain percent of equity into the property, you can either request to have it dropped or it will be dropped. So 20% equity in the property, you can request to have it dropped. At 22%, it is dropped. And then HOA fees, condo fees, front foot fees, ground rent fees. We had a prior episode, actually the episode before this, where we went into way further detail on what these are, because it's more than just, hey, it's a fee if you're buying into an association or something like that. But just to kind of break it down, if you have a condo fee or an HOA fee, these are fees that you're paying to be a part of an association or a community. And these fees are covering the common areas, the upkeep of them, all that good stuff. If you've got a front foot fee, that is basically a fee that covers the water and sewer lines that are being installed into the complexes that you're buying in. Ground rent, excuse me. Ground rent is if you are purchasing the home, but you don't own the land that the home is sitting on. So it's a fee that's being paid usually annually, and it's dragged out over 20 years, 30 years, whatever it's set at. And again, it's a fee to pay for the land that your home is sitting on. So those are other components of a monthly payment. But what are some factors that affect the monthly payment, Tim?
Yeah, so when we were putting together this episode, we were thinking, well, we could define everything and make it make sense to people, but the way that it becomes like a real tangible thing is by showing you how it impacts your monthly payment. So the first part of it is, the principal. It just, that is going to be whatever it is. So whatever your loan amount is, that's your principal. Obviously, the more you borrow, the higher your payment. But for the majority of your mortgage, the amount that you're paying toward the principal is smaller. Mm-hmm. And so you usually get more bang for your buck if you have a lower interest rate. And so, if you're in a situation where you're thinking, should I put down more money on the principal of the loan and owe less, or should I buy a lower interest rate? It almost always makes sense to buy the lower interest rate, because you will see the amount that you pay in interest over the life of the loan decreases significantly. So the interest rate plays a pretty big factor in what your mortgage payment is. And that kind of makes sense. Like, the higher the interest, the more your payment would be. The lower the interest, the less your payment would be. But, just being able to see what options look like. What if I finance this at this rate? Or what if I finance a little bit more at this lower rate? What does that mean? Like, what's that break-even period? When do I start making my money back quicker, kind of thing? So, having us run through exercises like that is kind of an important part of making this decision. The loan type and the loan term that you choose also makes a difference in what your monthly payment is.
Big difference.
A huge difference. So I think most people, when they call us, their idea of what I want for a mortgage is a 30-year fixed rate, just because that's what the mortgage has always been in this country for as long as we can remember. You don't have to do a 30-year fixed loan, right? Like, there are other terms of the loan you could do. And, generally when we're looking at guidelines to see what you're allowed to do, you could do a 10 or a 15 or a 20 or a 25 or a 30 or, even something in between. The 30-year gives you the lowest payment of all of the fixed rate mortgages. And I think that's why it's an attractive option for a lot of people. I remember back in the early 2000s, rates dropped below 6% for like the first time and, maybe even forever. And everybody couldn't wait to refinance, right? They could not wait to get to a lower rate. And a lot of people switched from 30-year rates at, 8% to an interest rate like a 4% on a 15-year. It sounds great, but what happens is, because you're paying it back over less time, the payment is actually a lot more than what your 30-year payment is. So, then you're forced to make a higher payment every month. Whereas if you did a 30-year, you have the smaller payment with the option to pay more. Mm-hmm. So the amortization that you have, whether it's a 10-year or 15-year or 30-year, whatever it is, makes a difference in what that monthly payment is going to be. You can always pay extra toward the principal, each month, knock down what you owe on the property, save yourself a bunch of interest on the back end of it. And, if something, God forbid happens, you lose your job or something like that, you still have that 30-year fixed payment, which is a lot more comfortable for most people, I would think.
Yeah. Yeah.
And then obviously the down payment plays a part in this. The more you put down, the less your payment's going to be. But again, there's a balance between how much you're using for the down payment and whether or not you might buy a lower interest rate, where interest rates are, which direction they're trending. If rates are coming down, maybe you don't buy a lower rate because maybe you're going to get a lower rate in a year or two when you refinance. So those are some of the factors that impact, what your mortgage payment is going to be. In general, just the shorter a period of time you have to repay the loan, the greater the payments. But the interest that you save over time is sometimes worth it. So
I've had a question asked, actually often, but as of recently too. Maybe you can help explain this. So the question was, if I put more money down, how does that affect my monthly payment? So we kind of have a rule of thumb, or at least I do on the team that we work at. Yep. But how would you explain that if somebody asked you that question? If I'm putting more money down, like how much more money should I put down for it to make a difference? And does it make a difference? Yeah. So it really depends on where rates are at any given time. So for instance, as of the recording of this video, interest rates are right around 7%, right? So I would tell most people that for every $1,000 you're putting down, you're going to save like $7.50. And that's a super depressing number because you think about, well, I've got
$10,000 that I want to throw at this mortgage and I want
Right.
to lower my payment, and you're lowering it like 70, 75 bucks
Right.
a month. Not that that's nothing, but you feel like you should get
Right.
more from that amount of money than what you're actually getting. But again, another thing you could do instead, you could maybe think about buying a lower interest rate, because that will actually decrease your payment significantly more depending on what your principal, what your balance is.
Mm-hmm.
You could save a lot more by paying down the interest rate instead of paying down the principal. So there's, if you have the money to work with, there's usually a way to structure it that makes the most sense for what your goal is, because some people buy a house with a 30-year mortgage knowing that they're never going to pay that 30 years. They're never going to be in the house that long. They have a 5-year plan or a 7-year plan or whatever it is. So maybe you don't buy a lower interest rate because you might not be there long enough to have it actually make sense to do.
Yeah.
So, talking to people like Tanner and I is I think is one of the most important things that you can do, because we figure out what your goal is and we help you figure out, okay, if you're there for 5 years, here's how much money you've spent versus here's how much money you would have spent in this scenario. Here's what your principal balance is. Here's how much equity you're going to have.
Right.
I think those are conversations that we have with people, and it's behind the scenes all the time that we're talking about things like this. And I think part of the reason you work with people like us is so you can get sort of, that counseling and figure out, does it make sense to do this? Does it make sense to do that? Does it not make sense to do either one of those, and should we go a different route?
Yeah, no, I totally agree. I think, that question gets asked a lot. And
It is.
You would think that putting more money down, that cut your payment in half or cuts it by a couple $100s, but you would have to be putting a substantial amount of money more down, kind of thing. Okay, so a couple other things that could affect your monthly payment. So let's say that you bought your house, you know how much it's worth at this point. So for me, for example, I do own a townhouse, and property taxes have gone up pretty much every year that I've owned it. Sometimes it's a couple $100s that it goes up. Sometimes it's like $50. It just depends. But my point in saying all that is, once you purchase your house is being reassessed every year by the government. So your taxes and the amount you're paying in taxes, that follows that home assessment and the value of your home. So once your home is valued, the taxes then follow. And if your home goes up in price or increases in value, your taxes are going to go up, and your monthly payment's going to go up. So that's something that you want to be looking out for. If you're a type of person that keeps notes of everything or something in a file, like just keep up with that and make sure that you're recognizing your home value, and you're looking at your taxes and seeing if they've gone up, how much they've gone up each year, things like that. Mortgage insurance, I know we touched on this just a little bit ago, but the way that mortgage insurance can change in your monthly payment is FHA, unfortunately, unless you refinance, it's part of your monthly payment for the life of the loan. Now, conventionally, like I mentioned previously, it does fall off at a certain percentage of equity put into this transaction. So once it does fall off, that could be a couple $100s a month less that you're paying, depending on what your mortgage insurance was that you're paying currently, kind of thing. And then, HOA, condo, front foot, and ground rent fees, they could go up as well. My condo goes up at least $5 every year. The front foot, I haven't really, this is so bad of me. I haven't really looked into if the front foot fee that I pay goes up or not, but do they typically go up?
No,
I don't think they do.
So. I don't think so.
But condo and HOA, they are definitely subject to be increasing. Yep. I've never met somebody that said, my HOA decreases this year. So plan and budget for those to be going up, especially if you're buying into, a home that has that type of thing, or you're paying into something like that. But then there's also tips that we have that you can help manage your monthly payment after you purchase your home. Do you have any insight on that?
Yeah. So, you mentioned a question about what happens if I have this much money and I want to put it down. How does it affect my mortgage payment? Another question that I get a lot, and I'm sure that you do too, is what if I make extra payments each month?
Yeah.
How will that impact what I owe? And so when you have let's just take a 30-year fixed scenario. If you have a 30-year loan, your principal and interest payment is the same every month. It doesn't change. The amount that goes toward the principal, the amount that goes toward the interest does change, but the amount that you are paying, so if it's $1,000 a month for principal and interest, it's $1,000 every month, regardless of how much you paid the month before or 2 months before. So the way that it works is if you pay extra toward a mortgage payment, and whether that's, some people do it once a year, make like a 13th payment. Some people kind of break it down over the course of the year, and they'll make 1/12 of an extra payment every month. So if your payment's $1,200, they're sending in $1,300 each month with the goal of making an extra mortgage payment each year. Generally, when you do that, and this depends on where interest rates are and what your principal balance is and how long you've been doing this, and are you disciplined enough to keep it up. But in general, when you make an extra payment per year, you can save anywhere between 4 and 7 years off of your mortgage. So if you have a 30-year fixed, you make extra payments, you could pay that thing off in 23 to 26 years. Just because you had the discipline to do that. So it certainly makes a difference it doesn't affect what your monthly payment is. Like, it's not going to decrease what your monthly payment is because you still will owe the same amount the following month, but you're kind of paying yourself at the end of the mortgage, right? Like, you're paying off the principal at the end of the mortgage as you're doing this. And so, the way that I look at it is you're paying your later self, and your later self probably won't be mad at you for doing that.
Yeah, no, I agree.
Yeah.
I think, so we used to send amortization schedules. Actually, do you remember that?
Yep,
so we
I
would
do.
literally print out, we would go into each person's loan that had closed, we'd print out an amortization schedule and we would send it to them. And we were just doing this as like a due diligence. But if you do make an extra payment, that amortization schedule is almost a moot point.
Yeah.
But
the second you make that first payment, it's done.
But at least having, and it's a document that you get as a part of your closing package as well. So that's another thing that you could be looking into to kind of keep track of your payments and stuff. And if you do make an extra payment, on the month that you do, write a note to yourself. So just keep a log almost.
Yeah.
Yeah.
Yeah. It's not bad to be disciplined that way.
No, not at all.
What else can you do to change your monthly payment?
So I guess it's changed your monthly payment. So an option, and I say this because I feel like sometimes people have no option but to buy when they have to buy. So they have to deal with the interest rates, whether they like it or not. And that's hard. You don't want to be stuck with this monthly payment for a really long time. That's scary, especially if you don't know what the future holds. So an option is to refinance down the line. Refinancing helps you get cash out if you need extra cash to work on your house or to pay bills off or whatever the case is, or you don't have to take cash out and you could do a refinance to get a lesser interest rate. And people are refinancing right now, whether people think that or not. It is an option for you. When you do a refinance, you're not coming to the table with as much money as if you were purchasing a home. You have the option to roll in closing costs into, the refinance situation. So you don't have to bring any money to the table when you refinance. And the goal is to get a lesser monthly payment, So to me, I always suggest refinancing to people who are a little bit iffy with purchasing at the current moment. And they're like, I don't want this interest rate, or this monthly payment scares me right now.
Yeah.
Yeah, I think.
Yeah, you have to be careful, because I feel like there were a lot of conversations that we were having in 2022. Rates are starting to rise, right? Like, rates went from the mid 3s to 6% during the course of that year.
Yeah.
And it was crazy. And so what we thought was a temporary blip in rates has turned out to be something much longer. And so there are definitely a group of people that bought a house late 2022 or 2023 with the intention of, in a year, in 18 months or 2 years or whatever, I'm going to be able to refinance. Fast forward to, we're at the end of 2024, rates aren't any lower, and in some cases they're kind of higher, and so some people aren't able to take advantage. But there's always a market for refinancing. Like you mentioned, people will need cash out. There's divorce and separation situations where one person has to buy the other person out, or, there's always some kind of refinance activity going on out there, and that's impacting what people's monthly payments are, for sure.
Yeah. People are still refinancing. I know people think that people aren't, but they are.
Yeah, that's true.
Yeah.
And then we've talked about having discipline and budgeting and things like that many, many times on the show. I think if you just keep track of what your payments are, just regular payments, if you have the ability to make more, go ahead and do that. Always keep an eye to the future. Know that, like Tanner said, property taxes are going to increase inevitably. Homeowners insurance is going to increase inevitably. If you have an HOA or a condo fee, those are going to go up as well. You need to plan for the future, right? That's all part of what getting a mortgage is about. It's about, the stability of, I need somewhere to live, first of all, but then I also need this payment that I'm relatively comfortable making Because your reality is you're the one making that payment every month, and you better make sure you make that payment.
Yeah. Or that you can.
Yeah, absolutely. Yeah, so you need to be comfortable with it. You also need to know that in the future, some of the fees that comprise your mortgage payment are going to increase. So, know what that could look like. Just have a mind toward the future to know that that's something that is going to be coming down the pike that you need to be ready for.
Yeah, I mean, this is one of the biggest purchases of people's lives. So you have to be diligent and financially intelligent.
Yeah. Yeah, absolutely.
Yeah.
And so I think that the combination of this episode and our previous episode, where we sort of broke down the parts of a mortgage payment that aren't really part of your mortgage payment, is something that you really need to consider, because obviously principal, interest, property taxes, homeowners insurance, those are what everybody knows about and everybody thinks about when they're buying a house. But there are all these other things that you need to consider, like the HOA fee, the condo fee, the front foot, etc.
I would highly recommend people listen to the last video that it goes into very detailed information about those things.
Yeah, I don't think that I've ever seen or listened to like a more comprehensive breakdown of those ancillary fees outside of your mortgage.
Yeah.
So it's really good. You should take a listen.
Yeah, agreed. But we just wanted to break down, obviously, the monthly mortgage payment, what it goes into it, what it means, how you can change it, or how it can change in the future, and just hope that you're almost prepared for things like this.
Yeah.
Because we don't want to put any of our clients in any type of financial issues, or, we don't want you walking away and being like, I don't think I can afford this, and I don't know what I got myself into. There is a thing called buyer's remorse. We don't want you to have it when you buy a house. So this is all very important stuff. Definitely go check out some of our older videos that we've shot, especially the one on condo, HOA, ground rent, front foot, because more than likely, a lot of people purchase into those types of situations. Definitely. So I think it's super important and informative.
Yeah, I agree. All right. Well, thank you for joining us today. We hope that you learned something. And if you have any questions, let us know. All right.
Yep. Have a great day.
All right. Bye.
Bye.